Hello, in this lecture we're going to define bad debts. According to Fundamental Accounting Principles, Wild 22nd edition, the definition of bad debts is accounts of customers who do not pay what they have promised to pay and expense of selling on credit, also called uncollectible accounts. When we're thinking about bad debts, we're thinking about that expense related to the accounts receivable for those accounts from customers that will not be paid for whatever reason. Either the customer went bankrupt, they disappeared, we don't believe we're going to receive payment on that receivable for which we did work in the past and have already recorded the revenue. This is just going to be an expense related to doing business in the type of business where we have to do work on credit, meaning we're going to do work before we receive payment. If we take a look at an example here, we have an accounts receivable account of $1,146,300. The question is, what happens for those customers that are not able to pay us? If we determine that a customer is not going to be able to pay us and their balance is in this total balance of the accounts receivable in some way, we're going to have to reduce that accounts receivable and we're going to have to record the related income statement side of that, which you might think should be going to revenue, because really what happened is we did work, but we didn't really get payment, so we kind of didn't get revenue. But we don't usually decrease revenue. Instead, we're going to put it to the bad debt expense. So the expense is going to go up, reducing net income for those customers that are determined not to be able to pay us. There is a question, however, about timing. Should we use a direct write-off method or should we use an allowance method? Direct write-off method just says we're going to write off this bad debt when it becomes determined that we are not going to receive payment from the customer. And the allowance method would say that in accordance with the matching principle, accrual principle, we want to recognize the bad debt expense at the same point in time that the revenue was earned and match the expense to that revenue in that way. In order to do that, we need to make an estimate. We also need to estimate the accounts receivable amount that will be uncollectible with the allowance for doubtful accounts. So under that method, we would be doing some type of estimate. One way to do that would say how much of that accounts receivable would be uncollectible. Let's take a look at it by how old these receivables are. So here's the total receivable, 30, 60, 90 days past due. And based on that, make some type of estimate of how much of those receivables we believe will be uncollectible. Then we can make a journal entry, debiting bad debt expense, crediting the allowance account for the amount to get to the allowance account that we determined it should be, thereby telling our readers, hey, this is how much people owe us, this is how much we estimate that will be uncollectible. Subtracting those two out will give the net receivable, and we'll record the bad debt expense related to the receivables from this time period, this sales amount, that we believe is uncollectible. We don't know who's not going to pay us, but that's the estimate, lowering the net income for that way. That's the allowance method. Other way of doing it is the direct write-off method. Bad debt expense on either method is, of course, an expense lowering net income in relation to those receivables that are determined to be uncollectible.